Justin leaned back in his chair, opened his banking app, and smiled. 4.5%. That's what his high-yield savings account was paying him. Not 0.01%. Not the insulting rates most people were stuck with. 4.5. On $20,000, that's about $900 a year. Passive. Safe. Smart. He thought he had solved it. He hadn't. Because while Justin upgraded the account, he never questioned the system. And that mistake? It's costing him more than he thinks. Hey, I'm Brian, and I spend way too much time thinking about where your money actually goes after you deposit it. If you want the highest return on your time, think of this channel as peer review for your financial decisions. If it doesn't hold up, we fix it. Now here's the uncomfortable part. Justin isn't the only one in this story. And somehow, he's not even the one losing the most. So who is? Her name is Sophia. And Sophia did everything right. She opened a savings account at a major bank, something like JP Chase or Wells Fargo, set up automatic transfers, avoided unnecessary spending, and kept a consistent balance. $20,000. Just sitting there. Safe. Responsible. Liquid. As of right now, many traditional savings accounts are still paying around 0.38% annually. That's about $76 per year on $20,000. 76. Before taxes. That's not a typo. And if you look at the data from the Federal Deposit Insurance Corporation, the average savings rate across large banks has hovered near that level for years, even while interest rates climbed. So Sophia logs in, sees a little interest payment each month, and feels responsible. She's following the rules. The rules she was taught. Save your money. Put it in the bank. Earn interest. She did everything right. By the rules she was taught. But here's what should make you pause. Where do you think the bank puts Sophia's $20,000? Just sitting there? Or working? And if it's working, who's really getting paid? Here's what the bank doesn't want you to see. That same $20,000 sitting in Sophia's account isn't sitting at all. It's being deployed. Relentlessly. Let's put that in real numbers. When Sophia deposits $20,000, the bank doesn't lock it in a vault. It uses a fractional reserve system, meaning it keeps a portion and lends out the rest. And where does that money go? Start with credit cards. As of early 2026, average credit card interest rates in the United States are hovering around 20% annually, according to Federal Reserve data. So part of Sophia's money gets lent out at 20%. She earns $76. The bank earns thousands. But that's just layer one. Now let's talk mortgages. Banks take deposits like Sophia's and package them into loans. Mortgages at rates around 6 to 7%, depending on the market. Again, the spread. They pay her less than 1% and earn 6 or 7. That difference? That's the business. But it doesn't stop there. Banks also invest in United States Treasury securities, short-term Treasury bills yielding somewhere between 4% and 5% as of Q1 2026. Let that sink in. They can take Sophia's money, buy government-backed securities at 4 to 5%, and still pay her 0.38%. And keep the difference. And then there are fees. Overdraft fees. Account maintenance. Interchange fees from your debit card usage. Multiple revenue streams. Same $20,000. Working in multiple places. That's the system. And Sophia? She sees $76 a year and thinks that's the return. It's not. It's her cut. A very small cut. Now here's the twist. Justin saw this. He understood something was wrong. So he moved his money. He upgraded. He optimized. He did what every financial influencer tells you to do. So why is he still losing? If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Justin didn't leave the system. He just found a better version of it. His high-yield savings account, maybe with an online bank or a fintech platform, advertises around 4.5% annually. On $20,000, that's roughly $900 per year. Already, that's more than 10 times what Sophia earns. So yes, Justin is doing better. But better doesn't mean optimal. Because there are 3 problems Justin didn't see. First, the advertised rate isn't always the real rate. Some banks offer promotional rates that drop after a few months. Others use tiered structures, where only part of your balance earns the full yield. And rates change fast. What's 4.5% today could be 3.8% tomorrow. No guarantee. No lock. Second, taxes. This is the part most people ignore. Interest from savings accounts is taxed as ordinary income, not capital gains, not preferential rates. Ordinary income. So if Justin is in, say, a 24% federal tax bracket plus state taxes depending on where he lives, that $900 quickly shrinks. After taxes, he might keep closer to $600 to $700. That's the number that matters. After tax. Always after tax. And third, the biggest one. The middleman didn't disappear. The bank is still taking Justin's $20,000, doing the exact same things it did with Sophia's. Lending it out at high rates. Buying treasuries. Collecting fees. The only difference? They're giving Justin a slightly larger slice. That's it. The system didn't change. His position inside the system did. And that's the part most people miss. The point isn't that high-yield savings accounts are bad. The point is, they're still the bank's game, just with better marketing. So the real question isn't which savings account pays more. The real question is, what happens when you step outside the system entirely? And what does that look like in actual numbers? Same starting point, $20,000. 3 different paths. And we're only looking at what you actually keep. After tax. Scenario 1, Sophia. Traditional savings account at 0.38%. That's $76 per year. Now assume a modest combined tax rate of 24%. She keeps about $58. 58 on $20,000. That's the baseline. Scenario 2, Justin. High-yield savings account at 4.5%. That's $900 per year. Sounds great. Until taxes. Same 24% rate. And now Justin keeps around $684. Better. Much better. More than 10 times Sophia. But remember, this is still fully taxable at the highest ordinary income level. No advantage. No optimization. Now scenario 3. This is where it changes. Let's say instead of leaving the money in a bank, you place that same $20,000 into a short-term United States Treasury bill exchange-traded fund, something like SGOV, yielding around 3.8% as of Q1 2026. That's about $760 per year. Now here's the difference. Treasury interest is exempt from state and local taxes. So if you're in a state with, say, a 5% income tax, that portion disappears. Only federal tax applies. At a 24% federal rate, you keep roughly $578. Now pause. Justin still wins on paper. 684 versus 578. So the high-yield savings account looks like the winner. But here's the part that should make you pause. Risk, control, and dependency. Justin's rate can drop tomorrow. The Treasury yield is tied directly to government-issued securities. And more importantly, in Justin's case, the bank is still in the middle, capturing the spread. In the Treasury case, you're much closer to the source. You're not just earning interest. You're stepping into the role the bank plays. And that difference? It compounds. Because once you understand this, you stop asking, which bank should I use? And start asking something else entirely. Why am I using a bank for this at all? So what's the actual alternative? And how do you access it without making things complicated? The alternative isn't one thing. It's a category. Direct access to the same instruments your bank is already using. Without the middleman. Let's break it down simply. Option 1, the easiest. Treasury bill exchange traded funds. These are funds that hold short-term United States government debt, Treasury bills, and trade like a stock. You can buy them through brokerages like Fidelity, Charles Schwab, or Vanguard. Click. Buy. Done. They offer daily liquidity, meaning you can sell anytime the market is open. And as of right now, yields are sitting in that 3.5 to 4% range. Slightly lower than some high-yield savings accounts, but more stable, and with that tax advantage. Option 2, the pure version. Treasury Direct. This is the United States government's own platform. No bank, no fund, no expense ratio. You buy Treasury bills directly from the source. Full control, full transparency. You choose the duration, for weeks, 8 weeks, 13 weeks, and you know exactly what yield you're getting. This is as close as you can get to becoming your own bank. But it's less flexible. Your money is locked for the term you choose. So liquidity is lower. Option 3, the hybrid, money market funds, offered by firms like Vanguard, Fidelity, and Charles Schwab. These funds invest in short-term government securities and high-quality debt. They aim to maintain a stable value, typically $1 per share, while paying a competitive yield. And they offer near-daily liquidity. Think of this as the middle ground. More efficient than a bank. More flexible than direct treasuries. Now here's the key idea. The point isn't to chase the highest percentage. The point is to remove unnecessary layers. Because every layer takes a cut. Sophia had multiple layers. Justin reduced it slightly. These options, they strip it down. And once you see that, you can't unsee it. But I already know what you're thinking. Isn't this riskier? Isn't this more complicated? Let's talk about that. First objection, this sounds riskier than a savings account. It feels that way because you're leaving the familiar. But here's the reality. United States Treasury securities are backed by the full faith and credit of the United States government. This is the same underlying asset many banks rely on. The difference isn't the asset. It's your position. In a bank, you're insured up to certain limits by the Federal Deposit Insurance Corporation. With treasuries, you're holding the government obligation directly. Different structure. Same foundation. Second objection, this sounds complicated. At first, yes, because it's new. But opening a brokerage account today takes minutes. Buying a treasury bill fund takes seconds. And once it's set up, it runs just like your bank account did. Money in, yield earned, money out. The complexity is front-loaded. The benefit is ongoing. And that's the trade most people never evaluate. Because they stop at what feels easy, not what works better. So now, step back for a second. Look at both characters. Look at both decisions. And ask yourself one final question. Sophia trusted the system and earned almost nothing. Justin optimized inside the system and earned more, but still gave up control. Neither of them asked the deeper question. Where is the money actually going? Because once you ask that, everything changes. So the next time you see a high-yield savings rate, ask yourself this. Are you getting paid? Or are you just getting a slightly better slice of what was already yours? And if this kind of thinking helps you see money differently, subscribe. Think of it as the highest return you'll get on a few minutes of attention.